Good morning, real ECN listeners. Today is Monday, February the 3rd, and this is your Forex market commentary brought to you by Real ECN. By the way, Happy New Year if you're listening from China or Korea. Today's discussion is emerging market risks and how the dollar-yen cross, particularly the Japanese yen, can be a major beneficiary during this time. If you're trading the dollar-yen cross, I hope this commentary will provide you with insight for you to formulate your trading strategy. However, if you're trading the euro-dollar pair, which is highly sensitive to the risk aversion trade, this commentary is also relevant too. So first in line, we're going to discuss the technical front on the dollar-yen market. In accordance to the SSI ratio, also known as the Speculative Sentiment Index, retail traders has been aggressively piling onto the long Japanese yen positions. The most since the Japanese yen was trading at 99 yen back in November. The 102.00 level presents itself as a shift in momentum. If the price break below this level, the dollar-yen market are likely to set new decline for the pair moving forward. Analysis of a collection of technical indicators on the 5 hours time interval on the dollar-yen market suggests a temporary bearish market sentiment and recommend short positions on the greenback. The 5-hour chart interval also established short-term Fibonacci resistance at 102.63 and Fibonacci support at 101.72. The dollar-yen market began this week trading session below the 200-day simple moving averages. This trend action holds great significance as 200-day simple moving average contains more or less of 1 year worth of trading data, and it forecasts long-term market sentiment, and currently the pairs are trading below the 200 days simple moving average, which is indicative of a long-term bearish market sentiment outlook on the cross going forward. This bearish market sentiment is also validated by the dollar-yen pair opening today's trading session below the short-term simple moving averages, which include the 5, 10, 20, and 30 days simple moving averages. Also, collectively, they are indicative of sell recommendation on the technical front. So let's have a look at the 5 hours time interval indicator chart. So right here we have 10 different indicators. Just to quickly go through them, each of the indicators are strongly indicating sell, from ISI to MACD to CCI, down to bull to bear power ratio. So overall we have 0 buy recommendation from our technical indicators, and we have 9 sells, 1 neutral, with an overall technical consensus of a sell. So moving down to this chart, first of all, we have the S&P 500. So it is very important to understand that the S&P 500 is an indication of market appetite in terms of risk. Since December, the correlative strength between the S&P 500 and the dollar-yen cross have been sitting at 68%. This relationship is important because it can give a gauge to predict market sentiment towards risk, likewise as the Nikkei 225 to the Japanese yen. So let's have a look at this S&P 500 chart. It topped in around late December and early January before the decline we see right now. So is this an indication of risk aversion? So right now, what we see is a corrective decline in the S&P 500, which is also mirrored by a decline in the dollar-yen market. So moving down, let's have a look at this chart. So we have the Nikkei 225. Remember, the Nikkei 225 is also highly correlated to the dollar-yen market as well. So from late January, we see the correction in the Nikkei 225, which shows that market sentiment is changing. People are shying away from risk investment, and they are more risk averted, as we see in this correction. So a better way to understand risk is to look at the volatility index, which is the VIX. It measures the fear in the market, and right now, since January, risk is on the rise on 3 fronts. It's largely contributed towards risk events last week, which was the anticipation of the FOMC meeting and whether the Fed would taper or not, and of course the Fed did taper, which was in line with market consensus. And also we have the US non-farm payroll, which is a major risk event for this week, as well as the pending emerging market risk right now. So let's have a look at this chart. This chart is an iShare MSCI Emerging Market Index. Since October, the peak of Emerging Market Fund ETF, we see a gradual decline. And this is largely because since this December, the announcements of Fed tapering, remember the Federal Reserve is the number one liquidity provider. And it becomes the backbone of emerging market growth story back in 2008, 9, and 10. And since the Federal Reserve are tapering, we see that squeeze in liquidity and that fear in the capital fear out of emerging market back into safe haven, which is the US dollar and the Japanese yen. And of course, that one big drop decline is mirrored by Fed tapering last week during the FOMC meeting. So right now, let's explore the fundamental front. The Fed's tapering announcements last week was in line with what the market have expected, and that was a tapering at the pace of $10 billion a month, coupled with the rising risk from emerging market. This has set the underlying tone for the strengthening of the greenbacks. The recent currency crisis in Argentina also spanned to Turkey and Russia, strongly highlights the correlation between the Federal Reserve quantitative easing program with the liquidity base by which had greatly formed the foundation of emerging market growth story and asset inflation since 2008. Is now in danger as tapering action from the Federal Reserve is forcing money market to raise interest rate on funding investment into emerging market. The capital flight flowing out of emerging market forces the central bank to hike rate in order to aggressively stabilize their local currency as capital seeks safe haven in Japanese yen and US dollars. The Federal Reserve language from last week's FOMC meeting evaporate any doubts on mixed US economic data such as previous disappointing US non-farm payroll number or emerging market risks, which could potentially hinder the progression of the Fed tapering plan. Looking forward, greenback investors are upgrading the expectation on the dollar gain against its counterpart except for the Japanese yen. Both the greenback and the Japanese yen are considered as safe haven, and they are more likely highly sensitive to risk aversion trade. A full-scale risk aversion panic will greatly benefit the Japanese yen more than the US dollar. Investors are also paying close attention to this weak US non-farm payroll, with the market consensus forecasting moderate gain with employment for January. However, if the wildcard presents itself as another disappointing US non-farm payroll number like the last one seen in December, this can undermine investors' confidence in the Fed's tapering commitment as well as the future dollar momentum. The Japanese yen has also been the darling of carry trade currency with decades of record low benchmark rate from the Bank of Japan. Speculators often invest in riskier assets, chasing higher yield denominated their currency in Japanese yen. However, when crises arise from these investments, this is often the catalyst to unwind the carry trade by which the Japanese yen are beneficiary. According to the Bank of America Merrill Lynch data compiled last week, capital outflow from emerging market equities stand at $6.1 billion and $3 billion from the bonds. It's quite easy to draw a parallel between capital flight as an initiation to crisis scenes in Asia in 1997 and Latin America in the early 1980s. If the prevailing risk aversion gather traction, it only makes sense to trade along with the bullish Japanese momentum. Last week alone, investor power in equivalent to 623 billion yen into low-yielding Japanese government bonds. This market action is parallel to July episode where foreign flight into Japanese bond totaled to 790 billion Japanese yen. And during that time, the dollar-yen cross fell from 100 mark to 96 mark on the Japanese yen level.